Most Americans have absolutely no idea this exists. But did you know the IRS lets us digital nomads earn up to $130,000 completely tax-free? And no, this isn't some shady loophole. If you're a US citizen living and working abroad and you're not using something called the FEIE, you are literally just giving the IRS free money. Today I'm going to break down exactly how this foreign earned income exclusion works, why the exclusion amount is projected to hit $130,000 by 2026, and most importantly, how you can legally use it to reduce your US tax bill to almost nothing. This is one of the most powerful but misunderstood tax benefits available to Americans, so you're going to want to stick around for this entire video. Let's start with the basics. What exactly is the Foreign Earned Income Exclusion, or FEIE for short? In simple terms, it's a rule in the US tax code that allows Americans who live and work outside the United States to exclude a huge portion of their income from US federal income tax. Every year, the IRS adjusts this amount for inflation. For 2024, the exclusion amount is $126,500. And based on inflation projections, we're expecting that to climb to nearly $130,000 by 2026. That means if you qualify, you can earn that much money without paying a single dollar in federal income tax on it. This is a game changer for digital nomads, expats, and remote workers. Now, a critical detail here is the term earned income. This is where a lot of people get tripped up. The FEIE only applies to income that you actively work for. This means your salary from a job, money you make from freelancing or consulting, or income from your own business where you are actively involved. It's money you trade your time and skills for. What it does not cover is passive income. This is a huge distinction. So things like dividends from stocks, capital gains from selling crypto, rental income from a property you own, or interest from a savings account, none of that is considered earned income. You cannot use the FEIE to shield passive income from taxes. It's only for the money you earn through your active labor while abroad. So why did the FEIE amount jump so much, and why do we expect it to hit $130,000 soon? The answer is simple: inflation. The exclusion amount is indexed to inflation, meaning as the cost of living in the US goes up, the IRS adjusts the FEIE limit upwards to reflect that. In recent years, we've seen significant inflation, which has directly resulted in larger increases to the FEIE. This is actually a good thing for expats because it means the value of this tax benefit keeps pace with the changing economy. It ensures that the tax break remains meaningful year after year, allowing you to keep more of your hard-earned money. It's a direct reflection of the economic climate, and for Americans abroad, it's a silver lining to rising inflation back home. Now, let's get into the most important part of this whole process. How do you actually qualify? This is where the details matter, and getting it wrong can have serious consequences. There are two distinct tests you can use to qualify for the FEIE, and the one you choose will completely change your tax strategy and lifestyle. You must meet one of these two tests. You don't need to meet both, but you absolutely have to satisfy all the requirements for at least one of them. The two options are the Physical Presence Test and the Bona Fide Residence Test. Let's break down each one, because choosing the wrong one is the #1 mistake people make, and it's a huge red flag for an IRS audit. First up is the Physical Presence Test. This is the more straightforward of the two, and it's the one most digital nomads and first-year expats use. The rule is simple. You must be physically present in a foreign country or countries for at least 330 full days during any 12-month period. A full day means a continuous 24-hour period. The any 12-month period part is key. It doesn't have to be a calendar year from January to December. It could be from June 1st of one year to May 31st of the next, for example. This gives you some flexibility. However, the 330-day requirement is incredibly strict. If you are outside the US for 329 days, you fail the test. You get zero exclusion. There's no partial credit. You have to meticulously track your travel days. A day spent traveling over international waters doesn't count. A day you spend flying from a foreign country back to the US also does, and count as a foreign day. This test is basically for people who are committed to staying outside the US for almost the entire year, giving you about 35 days to visit the US. The second option is the Bona Fide Residence Test. This test is a bit more subjective and is designed for Americans who have established a more permanent home in a single foreign country. Instead of just counting days, the IRS looks at your intentions and the connections you've built in that country. To qualify, you must be a resident of a foreign country for an uninterrupted period that includes an entire tax year. So, for example, from January 1st to December 31st. But what does being a bona fide resident actually mean? It means you've set up a life there. The IRS will look for evidence like having a long-term apartment lease, a local residency permit or visa, paying local taxes, having a local bank account, and your family living with you there. You need to demonstrate that you are not just a transient traveler, but a genuine member of that foreign community. The big advantage here is flexibility. Once you've established bona fide residence, you're not bound by the strict 330-day rule. You can take longer trips back to the US for vacation or business without jeopardizing your FHR qualification. As long as you maintain your residence abroad, so which test should you choose? The physical presence test is great for your first year abroad, or if you're a true nomad moving between several countries. It's a numbers game. Just count your days. The Bona Fide Residence Test is better for expats who have settled down in one place and plan to stay for the long haul. It offers much more freedom of travel. However, proving bona fide residence can be more complex. And if the IRS questions your status, the burden of proof is on you. This is why keeping detailed records, your lease, your visa, your utility bills, is absolutely essential if you use this test. Choosing the wrong one, or failing to meet the requirements of the one you choose, can lead to a denial of your FEIE claim, a hefty tax bill with penalties, and a much higher chance of being audited. Many people think they can just spend half the year abroad and claim it, but that's not how it works. You have to be strategic and deliberate. Let's imagine a scenario. You're a freelance graphic designer. You leave the US on March 1st, 2024, and travel around Southeast Asia for the next year. You carefully track your days and make sure you spend more than 330 days outside the US before March 1st, 2025. In that 12-month period, you earn $90,000 because you met the physical presence test. You can file your taxes and exclude that entire $90,000 from your US federal income tax. Your tax bill on that income becomes zero. Now let's say after a year you fall in love with Lisbon, Portugal. You get a residency visa, sign a 2-year lease on an apartment, and open a local bank account. You intend to live there indefinitely. Now, you can switch to using the Bona Fide Residence Test. This means you no longer have to stress about counting every single day you re-enter out of the US. You can come home for Christmas for a few weeks without risking your tax exclusion, because your life is clearly centered in Portugal. Understanding and correctly applying the Foreign Earned Income Exclusion is one of the most valuable financial moves an American living abroad can make. It can save you tens of thousands of dollars every single year. But it's not automatic. You have to file a US tax return every year, even if you owe no tax. And you must file Form 2555 to claim the exclusion. It's a complex area of tax law, and mistakes can be costly. If you're considering this path, I strongly recommend consulting with a tax professional who specializes in expat taxes. They can help you determine the best strategy for your specific situation and ensure you stay compliant. All right, let's break down exactly how the Foreign Earned Income Exclusion, or FEIE, can slash your US federal income tax down to practically nothing. Not magic, it's just understanding the rules. Let's imagine a scenario. It's 2026, and you're living and working abroad, earning $130,000 for the year. The FEIE threshold for 2026 is projected to be around $130,000, but always check the latest official IRS figures. If you qualify for the FEIE, you can exclude that entire $130,000 from your US income. What does that mean for your federal income tax? It means it becomes zero, a big fat zero. You report the income, you claim the exclusion, and poof, the federal income tax on that amount is gone. But hold on, there's a huge catch here that trips up so many people. The FEIE only applies to income tax. It does not, and I repeat, it does not remove your self-employment tax. If you're a freelancer, a consultant, or run your own business as a sole proprietor, you're still on the hook for that 15.3% self-employment tax, which covers Social Security and Medicare. On $130,000, that's almost $20,000. That's a painful surprise if you're not expecting it. So, how do savvy expats deal with this? This is where proper structuring comes in. Instead of operating as a U.S. sole proprietor, you could establish a foreign corporation in the country where you live. You then become an employee of your own foreign company. By doing this, you're no longer considered self-employed by the IRS. Instead of paying a self-employment tax, you'll pay local Social Security taxes in your country of residence. Now, this strategy is powerful, but it depends heavily on something called a totalization agreement. These are treaties between the U.S. and other countries designed to prevent double taxation of Social Security contributions. If the U.S. has an agreement with your country, you typically only pay into one system. If there's no agreement, things can get complicated, and you might even have to pay into both systems. This is why it's absolutely crucial to understand the rules of the specific country you're in. Setting up a foreign company isn't a simple trick. It's a strategic move that requires professional advice to make sure you're compliant everywhere. Okay, so what happens if you're doing really well and earn more than the FEIE limit? Let's say you make $200,000 in 2026. The FEIE still works for you. You use it to exclude the first $130,000 of your income. That leaves you with $70,000 of taxable income. It's a lot better than being taxed on the full $200,000, but we can do even better. This is where you start layering on other tax-saving tools. First up is the foreign housing exclusion, or for the self-employed, the foreign housing deduction. This allows you to exclude a portion of your housing expenses, like rent and utilities, from your income. The exact amount you can exclude depends on where you live, as the IRS sets different limits for high-cost cities like Hong Kong or London versus more affordable locations. This can help reduce that remaining $70,000 of taxable income even further. After you've used the FEIE and the housing exclusion, you're left with your final taxable income. But we're not done yet. Now you can use the Foreign Tax Credit, or FTC. The FTC is designed to prevent double taxation. If you paid income taxes to your foreign country on that remaining income, the FTC allows you to claim a credit for those taxes against your U.S. tax bill. So if your U.S. tax on that remaining income is, say, $10,000, but you paid $12,000 in taxes to Spain or Thailand on that same income, the foreign tax credit could wipe out your entire U.S. tax liability. Now we get to the real power move, the ultimate combination for many digital nomads and expats, using the FEIE and the FTC together. This is a strategy that requires careful planning. Here's how it works. You use the FEIE to wipe out the tax on the first chunk of your income. Let's go back to our $200,000 earner. The first $130,000 is excluded with the FEIE. The remaining $70,000 is still subject to U.S. tax. But, and this is a massive but, this only works if you get it right. The IRS is not forgiving when it comes to mistakes with these foreign tax provisions. They're complex, and the compliance burden is high. A simple error can lead to the entire exclusion being denied, penalties, and a huge tax bill. So let's cover the most common mistakes people make, so you can avoid them. First, miscounting your days. For the physical presence test, you need to be in a foreign country for 330 full days in a 12-month period. A full day means a continuous 24-hour period. Travel days to or from the U.S. often don't count, and people mess this up all the time. Another classic mistake is maintaining too strong a tie to the U.S. when trying to claim the Bona Fide Residence Test. This includes things like keeping a home or apartment in the U.S. that's available for your use, even if you rent it out. The IRS can see this as evidence that your abode, your principal home, is still in the U.S., which would disqualify you. Spending too much time in the United States is another red flag. Even if you meet the 330-day test, frequent, long trips back to the U.S. can jeopardize your claim, especially under the Bona Fide Residence Test. A huge one is failing to prove foreign residency. You need to be able to show the IRS that you have genuinely moved abroad. This means having a foreign lease, utility bills, a local driver's license, and being integrated into your local community. You can't just be a perpetual tourist. Then there are the reporting forms. Forgetting to file your FBAR, the report of foreign bank and financial accounts. If you have over $10,000 in foreign accounts, carries massive penalties. Same goes for FATCA, reporting on Form 8938 for larger foreign asset holdings. These are separate from your tax return, but are absolutely required. Finally, a fundamental error is confusing the FEIE with the Foreign Tax Credit. They are two different tools that work in different ways. You need to understand which one or which combination is best for your specific situation. Choosing the wrong one can cost you thousands. Navigating these rules is complex, and the stakes are high. While the tax savings can be life-changing, it's not a do-it-yourself project for most people. Getting professional advice from a tax expert who specializes in expat issues isn't a cost. It's an investment in getting it right and protecting yourself. Thanks for watching. If this breakdown was helpful, make sure to like, subscribe, and hit that notification bell for more deep dives into expat finance and taxes. See you in the next video.